Hello, welcome to this Ned Davis Research podcast where we will help you see the signals. My name is Brian Sanborn, NDR's Global Head of Investment Solutions. In this episode, we'll be speaking with NDR's Chief Economist, Alejandra Grindal, regarding the impact of the U.S. Iran conflict on global economies. At the time of this recording, a 2-week ceasefire has just been announced. First, what is the impact of the war on the U.S.?
Thanks for having me, Brian. So a clear distinction of the economic effects will, and this is not just in the US, but also in other parts of the world, is just how long it will be, how broad-based it'll become. So obviously a short and contained confrontation would likely see only temporary impacts. We're still on the short side, but it's getting longer. But a prolonged conflict could raise oil prices enough to sustainably slow growth and sustainably increase inflation. And ultimately that results in that horrible combination of stagflation. Higher oil prices would quickly show up at the gasoline pump and then ripple through the economy through higher production and transportation costs. And even though the US is a major oil producer, domestic prices still follow global markets. We know it. So this would ultimately benefit these US producers, but hurt consumers, especially lower income households. Remember, we've talked about this K-shaped recovery, and they will now have to devote even more of their budgets to overall energy. So historically, we have found that oil price increases have been strongly correlated with PCE inflation. In other words, a 10% increase in crude typically adds about 0.1 to 0.2 percentage points to inflation. And obviously that makes affordability much more difficult. A sustained conflict, of course, will disrupt global supply chains. And this would be even beyond energy, things like metals, chemicals, fertilizers. And many US industries rely heavily on imported intermediate goods. And so any bottlenecks would just feed into these higher inflationary pressures. Higher oil prices and the corresponding rising uncertainty also weakens growth. So a 10% oil price increase historically is estimated to trim about 0.1 percentage points from real GDP growth, with elevated political and policy uncertainty having really downward effects on business sentiment. So if the conflict persists, this combination of slower growth, higher inflation would create that very scary stagflation environment, which historically has been one of the worst backdrops for US equities.
What is the impact of the war on Europe?
Yeah, again, it has to do with the length of the crisis, how prolonged it is. But unfortunately, the downside risk to Europe is proportionately, I would say larger than it is to the United States. And this is partly because the economy is dependent on outsiders for its energy needs. So it's just more sensitive to these price shocks. And within Europe, very energy intensive economies such as Germany just face even greater risk given exposure to both industry and then as well as the consumers. In fact, the IFO Business Expectations Survey for March is just a great leading indicator to the German economy. It did highlight these war concerns. The index actually plunged to its lowest level in over a year. So in terms of Europe, and this is specifically the Eurozone, for every $1 increase in the real price of crude, Eurozone real GDP growth has typically slowed by 0.03 percentage points. So overall, this means that if crude stays within its post-attack ranges, we could see real Eurozone GDP growth shaved off by somewhere between 0.5 to 1 percentage points. And that's holding all else constant. Unfortunately, the higher end of that range could put the economy into stagnation because Europe's potential growth is relatively low to begin with.
Lastly, what's the impact on both Japan as well as China?
Yeah, so very interesting. So Japan, like Europe, is a net energy importer, but historically we've found it just has to be a little less sensitive to oil price shocks, I would say, at least compared to Europe. So according to our estimates, if crude prices stay within their recent ranges, history suggests Japanese economic growth would be reduced somewhere between 0.2 to 0.4 percentage points, which is not quite as big as Europe, but given that Japan's economy has such a low potential growth rate, it would still be quite damaging. It's quite a bit. If I can even offer some good news, the latest PMIs for March showed that Japan, still saw some damage, but actually sustained the least damage compared to most other major economies. And the quarterly business Tankin survey was also pretty resilient. So far things are holding up okay, but what concerns us is that Japan is just really vulnerable to the closure of the Strait of Hormuz, where nearly all of its energy supplies are channeled through. So along with the weak yen, which, as we know, lifts import costs, we could see a little more damage than normal if this situation in Iran is again prolonged. I mean, that's really the wild card. Moving on to China, the war and its impact on oil prices actually is a bit more of a nuanced view. So again, like these other economies we mentioned, it does rely heavily on imported crude, and a lot of it is channeled through that Strait of Hormuz. But in line with its rising self-reliance, China has actually built extensive stockpiles and has invested in quite a bit of renewable energy in recent years. So this does shield China, at least, for a little bit of time, from what would have been a much larger shock. Where the Iran crisis poses, I would say, the bigger risk to China is actually through global demand and global trade and supply chains. If you've focused on maybe past podcasts, overseas demand in China, has really upheld economic growth in recent years. And so if the deterioration in global demand is caused by a surge in oil prices, that could obviously have knock-on effects on Chinese exports. And China's largest export partners now, specifically Asia and Europe, which we just talked about, are some of the most adversely affected by oil price shocks.
Alejandra, thank you for your insights. NDR clients can read Alejandra's research notes in her weekly global economic focus publications. The indicators Alejandra and the research team develop for our subscription service are also used in our model portfolios, which are available for direct delivery on TAMPs and as ETFs. For more information on NDR, we encourage you to visit ndr.com. Also, for those listening in audio-only mode, video versions, including the charts of See the Signals, are available by going to info.ndr.com/ndr-signals. Thank you for joining us as we help you to see the signals. So long.